All right. Welcome to the show.
All right. We made it.
We're here. I hope everybody else is too. All right.
Yep,
what do you got
absolutely.
for us this week?
All right. It has been another exciting week. And as we're talking here on Friday morning, it seems like it's going to be a rocky weekend, but we shall see. So we're not going to see it in the data until next week. And so let's just see what we had going on so far this week, 15 June 2025. So we'll talk about what happened this week. How do we anticipate a top? What happens when the 20-day moving average line crosses the 200-day moving average line? Bonus chart's going to be taking a look at the rotation that's happening right now, really going from the Magnificent Seven tech stocks into the energy sector, and then the TSP Fund charts. So Monday, one of the big things we've been talking about the last few weeks is the bond auctions that have been happening and the fact that we have to roll over about 25% of the federal debt by the end of the year. And the higher the interest rate we have to pay to sell those bonds, the more that gets added to the deficit. So on Monday, we had a 3-month and a 6-month bond auction. Both of those rates remain the same as the last bond auction. So that's kind of a good thing. U.S. Trade Representative, Commerce Secretary, and the Treasury Secretary met in London with the Chinese Finance Ministry to negotiate a trade deal in China. We got the results of that Tuesday or Wednesday, but the S&P was up 0.09% on Monday. Then on Tuesday, Business Optimism Index jumped from 95.8 to 98.1. We also had, so that was positive. We had a 1-year bond auction that closed at 3.94 versus 3.93, which is a 0.25% increase. Not a huge deal, right? Not a really big increase, so that's good. The 3-year bond auction closed up quite a bit, right? 3.972 versus 3.824, which was a 3.87% increase. So we're paying almost 4% more for investors to buy 3-year bonds than they did at the last auction. And S&P is up 0.55% on Tuesday. And then on Wednesday, we hear about the trade negotiations from London. They came back and said that they have a roughly an agreement in place, but obviously the presidents of both countries have to sign off on it. 30-year mortgage rate ticked up a little bit to 6.93 from 6.92 last week, and new applications were up a lot, right? 12.5%. So people definitely think that inflation is going up, rates are going up, and so they're trying to lock in mortgage rates before that happens. We also had CPI on Wednesday, which was a really big number economists are looking at. Both core and non-core rose 0.1% versus rising 0.2% last month, right? So the expectation was that those numbers were going to be much higher because of inflation. So as of now, we are not seeing this massive inflation due to tariffs. It may be coming later in the summer, but right now we're not seeing it in the data. We also had a 10-year bond auction that closed up 1.8% from the prior auction. Not all that bad, but all of these are moving up, right? It means that we're paying more and the deficit is going to increase by that amount. S&P is up 0.27% on Wednesday. Then on Thursday, we get PPI, right, which is the producer side of CPI. PPI is up 0.1% after being down 0.2% last month. So it was up a little bit relatively, but still, even on the producer side, you're not seeing a whole lot of inflation coming into the system yet. Initial jobs claims were flat. They were 248,000 last week, 248,000 this week. So not much movement in unemployment. Unemployment's still at 4.2%. And we had a 30-year bond auction, and that closed up only 0.5%. So things aren't getting too out of control yet. Hopefully rates continue to stay down. With CPI and PPI both coming in lower than expected, it's saying that inflation is not going up, so rates should not be going up. So it's kind of kicking the can down the road. And then Friday, we got Michigan consumer sentiment. This is the first month that consumer sentiment actually rose a little bit. But I got a couple of really interesting charts about that. So this is consumer sentiment over time, right? It's a long-term chart going back to 1961. But we haven't seen, I mean, this level of negative sentiment is pretty significant, right? This was the bottom from the great financial crisis. So people are about as pessimistic now as they were at the bottom of the great financial crisis. And the stock market is essentially at all-time highs, right? What's interesting about this, and it's unfortunate because it really puts the consumer sentiment numbers kind of in question. This is the same chart, but it's broken out by political party, if you're Republican, Democrat, or Independent. And a couple interesting things I wanted to point out. So they generally, you don't have to worry about the difference, right? You got Republican Party up here, Independent here, and Democrat down here. So if you call yourself a Democrat, when they ask you these questions at the survey, right, they put you into this bucket. What's kind of interesting is most of the time they're going in the same direction, right? For most of the time, they go in the same direction. When you have an election, when Biden got in the White House in 2020, you got the Democrats thinking things are going to get better, and the Republicans thinking things are going to get worse, right? And then here you got Trump coming in, and Republicans think things are getting better, and Democrats think things are getting worse. So there's always some kind of overlap, it flips, and then it starts to level out. And the interesting one is what the independents do, right? Independents were basically flat here when Biden came in, but the independents are tanking, right, since the beginning of 2025. So it definitely affects the numbers. If you just look at the mainline numbers, they're asking people what they think. And so it's not hard data, it's soft data. It's useful, but it is what it is. All right, so how do we anticipate a market top? So this is a chart of the S&P 500 on a weekly basis. Okay, so each one of these ticks is 1 week of price movement. This is a relative strength indicator and the MACD oscillator. Okay, so what we're trying to do is anticipate a top. One of the best ways to do that is to look at long-term price divergence. So back going into 2022, you got price rising, but you've got relative strength falling, okay? And you don't have, the MACD is flat. It's not going up along with price. So momentum is not going up and relative strength is going down. So this is telling you the market's weakening, even though price is continuing higher. And that's what you tend to see before some kind of significant rollover, okay? You don't get it all the time, right? We didn't get it here or in the summer of 2023. We had a pretty good peak. Relative strength is going up, price is going up, everything's fine, and it just kind of rolled over. So you don't always get divergence at the top, but when you do, it's really helpful. We did get it at the top. Prices was moving higher going into 2025, but relative strength was rolling over, and we got that big pullback into April. Right now, if you're looking at it on a weekly basis, you got price going up. We're above that. In this case, I used a 9-week moving average line. So we're above the moving average. You got RSI above 50 and MACD still expanding to the upside. So not only do you have no divergence, everything's getting stronger. So on a weekly basis, everything looks good, right? The VIX. The VIX is a fear index, right? This was COVID. As you would expect, when the market really started crashing, the VIX spikes, okay? But prior to that, we were seeing higher lows in the VIX, and higher highs, even before COVID really took off, which is telling us that fear is coming into the market, and necessarily in anticipation of COVID, but something's definitely going on. And then COVID happened and away it went. Once VIX peaks and starts coming down and we put in lower lows and lower highs, that's when things started to, the rally in 2021 got going, right? And then once the VIX hits a bottom, it's not moving any lower, right? Which means the level of fear is pretty much where it's at and things are stabilizing out. And then once we start getting higher lows again, we're going into the 2022 rollover, right? So the VIX is pretty useful. If we go to where we are now, we had a low in the VIX going into the beginning of the year, which corresponded to a top in the market, right? We get a little spike, a pullback, so we get a higher low in the VIX, a higher high, a higher low. So fear is coming back into the market here. This is the April spike in the VIX, right, when the market bottomed. And then since then, the market's been rallying and the VIX has been falling. But if we look at it, you got higher highs, or higher lows rather, in the VIX until this point here. So if you drew that trend line, we've broken to the downside through the VIX. So in the short term, at least since this bottom right here, we got to break down through the VIX, which is positive, right? Because when the VIX is moving lower, the stock market is moving higher. So things look pretty good with respect to the VIX going forward, at least in the short term. So this is a chart of the S&P on top, the 1 month highs in the S&P and 1 month lows in the S&P, okay? So if the market is going up, you would expect a lot of 1 month new highs, or the percentage to be high of 1 month new highs, and you expect it to be low. 1 month new lows, you'd expect to be really low, right? So as we approach a high, if it's weakening, you would expect to see a decrease in the number of new highs and an increase in the number of new lows before the thing actually rolls over. So that's what we saw kind of going into the beginning of the year. You got a decrease in 1 month new highs, even though price is continuing higher, right? And you got a pretty big ramp up in new lows before price starts rolling over, okay? So if we go forward to where we are right now, you got price moving higher. You have a lower high in 1 month new highs, right? Which is a divergence. You want to see the 1 month new highs continuing higher as price continues higher. So that's on sort of on the negative, but we're not seeing a bunch of new lows spike up. So all in all, this isn't a bad chart either, right? It's not saying that the market should be rolling over. And if we look at it on a daily, we are, the MACD is flat, okay? What you want to see is MACD rising as price is rising. So with price rising at a rate like this and MACD flat, there's not a lot of momentum behind that move. You had a peak in relative strength back here, which was this high. You got a little pullback, but since then, relative strength has not taken out the prior high, but price has taken out this high. So again, it's divergence. And as we're recording this, the market is rolling over, which is going to confirm that divergence. Because if we start ticking down and relative strength starts going down, having not put in a prior high, that'll confirm this divergence and the market's likely going down. So on a weekly basis, things look good. On a daily basis, things are kind of shaky. Okay, so that's kind of how you're anticipating a top, right? There's a lot more risk to the upside than there is, a lot more risk that the market goes down from here versus opportunity cost that the market goes up from here. So once you make a decision one way or the other, one way to keep track of it, to know if you're on the right side, is to look at a 20-day moving average versus a 200-day moving average crossover. So if we go all the way back to 2019, really 2018, the The red circles are when the 20-day, which is the blue line in here, when the 20-day crosses down through the 200-day line in red. Okay. So by the time that crossover happens, the market's already been falling because the 20-day moving average of price is rolling down through the 200-day moving average of price. So at this point, the market has already been down this much. The value in it is to know whether or not, let's say you get out of the market back up here, to know whether or not that decision turns out to be correct. Because if the crossover happens, nothing good happens below that 200-day moving average line. And it's the same thing on the reverse. Here was the bottom. So ideally, you would get back into the market somewhere down here. But once it crosses over, right, now you can have a lot more confidence that the rally is going to continue. Okay. So it's not a timing tool as far as when to get in and out. It's confirming the trend. So if you're out of the market here, for example, you're on the wrong side. If you're in the market here, you're on the wrong side. Okay. So where we are right now, we had that crossover earlier in the year, came down, put in that April low, and now we have the crossover to the upside. Okay. So anybody who got in anywhere along here, back into the stock funds, this is confirming that you are now on the right side of the market because we're above that 20-day moving average line. And the crossover, not only is price above it, but the 20-day moving average has also crossed above it. So the trend is definitely going up. Can certainly roll over going forward, but for right now, the trend is going up. Okay. Trend is going up. That's at the index level. Underneath that, we know that tech has been driving this rally for a long time, and energy has been lagging. So this is a chart of energy versus the S&P 500. Okay. If you remember back in 2022, when the S&P 500 peaked, energy relative to the S&P went straight up. Okay. So in actual numbers during that time, the S&P was falling and the energy sector was actually rising. It wasn't just rising relative, it was actually rising. So when this ratio is going up, it's generally not good for stocks, right? Because generally when tech is going up, energy is going down, and when energy is going up, tech is going down. So the value of this chart is, this was the low in the ratio back here at the end of 2020. This was the peak in the ratio which is basically the bottom of stocks in 2022. Since then, the ratio pulled back to that 0.618 retracement level. Okay, tested it here, and looks like it's breaking out to the upside. So if energy relative to the S&P breaks out to the upside, that is not good for the S&P 500. Okay. This is what energy looks like by itself. So the price of energy of XLE peaked in mid-2024 and basically went flat to down. And then this week, it's got a pretty big breakout to the upside. Okay. We got, since that low in April when everything bottomed, I drew that trend line right there, and we held support for weeks along that trend line, and it's breaking out this week. So energy is certainly breaking out, and when that happens, it's generally not good for the S&P 500. This is a Magnificent Seven. Okay, it's an ETF that captures all of the Magnificent Seven. You got price going up, but this was the peak in relative strength. So relative strength has been declining, MACD has been flat, and price is going up. So this increase in price in tech is happening on weakening fundamentals, right? What's happening below the actual price is weakening. And that is as opposed to energy, which relative strength is increasing, MACD is increasing, and price is increasing. So if you had to choose between being in a Magnificent 7 ETF versus an energy ETF right now, it's pretty clearly you'd be better off being in an energy ETF. And we know that the Mag 7 is what has been driving the S&P. So none of this is good for the S&P 500. All right, so what do we look at in TSP Fund charts? Again, this is as of the close on Thursday. The market is kind of rolling over today on Friday, so it's very possible that this turns into a negative or a flat for the week. But we shall see. So each of these ticks is 1 week of price movement. This is the 20-week moving average line. As long as price is above that 20-week moving average line, right, the default has to be you need to be in the stock funds. Once we get above that line, we tend to stay there for a while, right? Once we get below that line, nothing good's happening. So that 20-week moving average line is pretty critical. We still got relative strength above 50. So on the weekly basis, as of now, things look pretty good. S Fund also is rolling over today after last week's kind of doji at the top, so not great. You could also draw this trend line in the S Fund. It looks like we're going to put in a higher or a lower high in the S Fund. So we had a peak, a lower high. If we get another lower high here, and certainly if we get a breakdown through that 20-week moving average line, S Fund is moving lower. I Fund, it's still certainly the best fund, way overvalued on a short-term basis, and now really on a weekly basis. But there's a lot of rotation happening. The dollar is at a very critical support level. If the dollar gets any lower, or as the dollar gets lower, if it continues down, it's a huge tailwind for the I Fund. The I Fund continues higher. What we really want to see is some kind of reasonable pullback, ideally back down to that 20-week moving average line as a place to get back into the I Fund. Because if the long-term rotation from US stocks to international stocks is happening, you're still going to get a pullback. You'll get an opportunity to get into the I Fund. But buying it up here at these levels is fine if you're going to hold it for a long time. But at some point, we're going to get a pullback to some reasonable level, which will give investors in TSP an opportunity to get into the I Fund, and investors in general an opportunity to reallocate out of US stocks and into international stocks. And the F Fund, I think, is the most interesting chart, basically because the F Fund is breaking out this week. We'll have to see if that breakout holds, but we've been on that 50 relative strength line for a long time. And we're right, getting support right around that 20-week moving average line. So if yields fall, right, if bond yields fall, the F Fund goes up. You got CPI and PPI coming in less than expected and very low, which is saying that inflation is staying flat, and if it starts to come down, interest rates come down, the F Fund goes up, and there's a lot of support right here. So it's a pretty low risk entry level to get into the F Fund at this point, and it can definitely move higher if the stocks start moving down. And there's a lot going on in the world, so there's certainly nothing wrong with taking the 4% rate of return in the G Fund, which always goes up and to the right. Questions?
As usual, if you guys got any questions, put them in the comment section wherever you find the video. If there's no comment section, you can shoot us an email, support@growmytsp.com, and they will get it over to us. Hopefully you guys got some good info out of it. If you like the show, please share it with your friends. We enjoy doing it, and we like it when you watch.
Absolutely.
All right. We'll see you guys later.
Later.
Maybe. Let's see. There we go.